Right, next up, we have Hannah Halaburda from NYU. So,
thank you very much. Okay. All right, thank you very much. Okay, so let me start by saying that I am a big fan of this conference, going back to the original first one in 2019, and I'm very happy that the program committee decided to include our paper. This paper with Yanis Bakos is kind of a still very much working paper. So we welcome any questions, comments, and discussions now, later, over happy hour. So please let us know, how we can improve it. We are asking a question whether DAOs are going to help us improve the organizations, and specifically, like, will they replace platforms? Okay, so blockchain technology is going back to Bitcoin, right? Because blockchain technologies is basically, by now, anything that got inspired was inspired by Bitcoin. Going back to Bitcoin, they promise decentralization, disintermediation, democratization, which will bring leveling playing field for the entrants, creation and better creation and fairer distribution of value. And we start with Bitcoin, and then we have altcoins, and then we have smart contracts and DeFi's and DAOs, and every generation of this technology is promising those things. So we think that generally, this is kind of a call for common umbrella here. Generally, we should scrutinize the claims under what conditions, and in which situations do we really see these promises delivered upon. Okay, because sometimes it works and sometimes it doesn't. So that we can think about where this technology is going to bring us in the future, not just the current liquidity, but if we implement it on scale, where are we going to get? So specifically, when we think about platforms, what we see nowadays, and there is a number of court cases going on, and trials, and a lot of social unhappiness about platforms, traditional platforms like Facebook and Google and Amazon, are becoming very powerful intermediaries that will extract value from the system and cause a lot of inefficiencies. And the value may be in terms of price, the data, the excluding competitors and losing competition in the ecosystem. Okay, so in this context, we say that blockchain technologies, broadly speaking, enable new design choices. Okay? They enable new design choices with smart contracts and permissionless blockchains that allow for, to some extent, censorship-resistant actions and transactions. And specifically, the centralized autonomous organizations, DAOs, promise to prevent this value capture that is happening by powerful intermediaries and efficiency loss. Because they say, imagine that Facebook would be run by a DAO, right, where the users vote. And now we are going to have this decentralization, disintermediation, because we're going to get rid of Facebook. And this is going to create efficient outcome and fair distribution of this value that was created. So first, the value will be, there will be more value created and will be distributed more efficiently. Okay. And by the way, we already have some DAOs that we see they are functioning, like MakerDAO sustaining DAI stablecoin and Uniswap. So let's take it a step further and let's decentralize everything, okay? So what we are asking, or what we are seeing in this paper, is that doesn't work quite so simply. It's not that if you're going to decentralize, we are going to remove this centralized intermediary, then you are going to have this full decentralization, disintermediation, equitable distribution of value, because there is a difference between what technology enables us to do and what are we going to get in an equilibrium. Okay. So the setting that we are exploring is a number of potential a market with a number of potential platform users, and they have different types. They differ in their types, and as their types differ, their utility from joining the platform is also differing. So their utility of joining the platform depends on their type. It depends on their type, and also it depends on the size of the network. Right, and to the extent that it depends, it's measured by the strength of the parameter that measures the strength of the network effects. And then there are some other parameters that let us manipulate these different aspects of this utility function, right? With a different level of differentiation in the utility received from the platform, and also some sort of scaling parameter. Okay, so we have this utility function that potential users are going to get. The outside utility is 0, just as a benchmark, right? And we are going to have a single platform that will set the access price, access price for all users. It will be uniform pricing. Yes.
The network effect is always positive, or it can be negative.
So we assume here we.
The question was if the network effect is positive, or it could also be negative.
So this is going to be always positive. This is always going to be positive. It would be interesting to see, like,
you can imagine that there might be some competition. For example, if the platform is adopted more by others, then you will reduce your utility.
Yeah, so there may be congestion effect, right? So we're more thinking, like, let's start. So I'm going to even start simpler than this, but yes, the network effects are positive. So you would like to get, as we are going to see, you would like to get lower price to increase the network, so that everybody is going to benefit from it, okay? Because otherwise it's also more complicated with negative network effect. Okay, so this is a quite complicated model, and I'm not going to, given that it's a shorter presentation, I want to give you a main intuition behind the result and driving forces. I'm going to take a simpler model where I'm going to reduce a number of many of those parameters. I'm going to assume that the types are distributed on uniformly on between 0 and 1, and utility is basically your type. So I'm only going to even abstract from the network effects and I'm going to comment how network effects are going to exacerbate the results. So in this simpler setting, right, we have now n potential platform users. They have their utility of joining the platform, that is their type. And the distributed uniformly 0 and 1. And the reason why we assumed this particular parameters in this particular model is that we're at some price p, we are going to have 1 minus p times n users to participate. This is giving us, very deliberately, we chose something that is giving us a textbook example of demand curve. So in this environment, a centralized monopolist that faces no cost of providing the good is going to set up the price equal to 1/2, is going to serve half of the market. Half of the market will be happy, half of the market will be unhappy, creating deadweight loss, okay, and inefficiency. So, okay. So now let's suppose we have this monopolist that is creating deadweight loss and is creating this inefficiency and extracting value from the system because it's making money, maximizing the profit. So let's say that instead of this monopolist, now we have a DAO. Now we don't have any central authority setting the price. And now let me just comment, we focus on the price here, but that could be any decision that is extracting value from the system. That may be decision, how much data are we going to provide to the advertisers? And the more data we're going to provide, which we don't like providing data, the higher advertising revenue we are going to get, right? So that is basically representing any potentially value extracting decision. So now, let's consider there is no central authority making this pricing decision, and instead, all potential users get a governance token with which they can vote on what this access price will be, right? The DAO, okay? Now, after they voted on the price, each of them decides whether at this price they want to join or not. Right? And if the price is positive, there's some profit collected. So what is happening with this profit? Now, this is collectively owned enterprise. We all own it. So we are going to distribute this profit to the token holders. So that if there's any positive profit, then this then it's distributed to token holders as a dividend. Okay, so this falls into under many of the DAO structure, at least envisioned and DAO structure. Okay, such DAO could set the price to be 0. Of course, it could by voting. And if this happens, everyone joins, everyone gets their utility. Social welfare is maximized. There's no dead weight loss. This is the socially optimal outcome, right? So this is exactly what we say would, many people would say would happen. Okay, so possible, it's possible they could, but is it going to happen in equilibrium? So the first thing to note is that some potential users with low utility of joining the platform may actually prefer to set a high price. At the high price, they will not join and not enjoy the platform, which gives them low utility. But if this high price realizes, they're going to enjoy high dividend, and that may be higher. Okay, so they are going to basically, if they know that they are not going to be using the platform, they just want to maximize exactly this, maximize dividend, which gives us exactly the monopoly price. So those token holders who are not using, they want to set monopoly price. For those who expect to use the platform at a given price, they will get some utility from using the platform, the price that they will pay, and the dividend. The dividend is always going to be smaller than the price that they are paying. So they will always want to set the price to 0. So in our model, as we chose the uniform distribution in this particular utility function, right, we are going to have following payoffs. So the green line represents the payoff for a user at price equals 0, and the red line represents a payoff to non-user at the monopoly price. Okay, so at this for this particular example, we're going to have types above 1/4 preferring to participate in setting price 0, and prices and types below 1/4 to not participate and set monopoly price. Okay, so with majority voting, we're going to have 75 against 25. The DAO is going to set the price to 0. But you can maybe already see that this is sensitive to our assumption how the types are distributed. Because if we distribute types more heavily here, then it's going to be still 0. But if it's more heavily here, we are going to have more of those investors who don't want to participate. We are going to get monopoly price. Yeah.
How do I think about the assumption that all the potential users get a token? I mean, in reality, how would I think about this? Because everyone is a potential user of like many apps, right?
Okay, so one thing, and that may be a good time for detour. One way we're thinking also about it is in dynamic terms. So let's say that one period only users get the token, but let's say that the first period the price is 0, and everybody who wanted to join had any reason to join at 0 gets the token. The next period, those are potential users of the platform in the second period, but before they use the platform in the second period, they all vote for the price in the second period. And now they may also want to vote for a low price. So this would work as well. And this is sometimes what happens. It's like we heard the talk about the yield farming. Right, so you get the token, the governance token for participating in liquidity pool, and Jona was presenting, and then you get this token for participating in liquidity pool, but you keep this token even though you may not be participating in the next period. Okay.
There's no secondary market for the tokens. Excuse me, sir. Oh, sorry. There's no secondary market for the tokens. As in, if I was a very high K user, I'd buy a lot of tokens.
Okay.
For the low ones
Okay.
too.
Okay. Thank you very much. So One assumption that is needed here is particular assumption on the distribution of types. And the second, this works assuming that everybody has one token and votes with one token. If they are tradable, secondary market, right? Which it is, right? It kind of falls apart. So even platform users may prefer to set higher price than 0 if they own more tokens, right? And it follows from a very simple relation is as we have more tokens, now the price that I pay stays the same, but I'm going to earn more dividends. So now the price that other people pay will have more weight than the price that I pay. So I will want higher prices. The more tokens I have, the higher price I would like to set, even if I am using the platform and I want to set and I will need to pay the price. Okay. So this is one reason why there are incentives to acquire more tokens, right? So first of all, each token is worth at least the dividend. So if I want to pay, if I'm willing to buy one, I'm probably willing to pay more if the price is below the dividend. But some of them are actually worth more because maybe getting another token will help me or allow me to change the price to my more preferred higher price in the voting. Okay. And if I get majority of the token, then a majority of the tokens that I'm going to be single-handedly setting the price. Okay? If I'm single-handedly setting the price, if I am the user majority holder, I'm going to set this price, which is increasing with the more tokens that I have. And if I am a non-user having a majority of the tokens, then I'm going to set monopoly price. Okay? So with that kind of as a background, I'm going to jump to equilibrium results rather than drag you through the mechanics, but I'm happy to discuss how everything works out. So we have one encouraging result and one less encouraging result. Okay. So the encouraging result is that we find that there is limit to concentration in the concentration of governance tokens. So if we start with, let's say, everyone having just one token, right? With tradable, so actually, no matter how we start, with tradable tokens in equilibrium, we're going to get the result that no agent is going to hold more than bare majority of the tokens. Okay? So why is this the case? If I don't have majority of the tokens and I want to buy a token from somebody else, so the token holder will say, you need to pay me at least the dividend. You need to pay me epsilon more than the dividend for my token. Okay. And if I'm as a buyer willing to pay epsilon more than the dividend for the token, the seller knows that the only reason I'm buying the token is to increase the price. Okay. If he knows that I'm going to increase the price, he wants me to pay not just epsilon more than the dividend, but the difference in price. So now the tokens are actually expensive, and they're more expensive than what I'm going to get out of them. So I may be willing to overpay for those tokens up to majority, because this is a qualitative difference in me in allowing me to set the price and making sure that I am getting my optimal price, my most preferred price. However, if I need to overpay for more tokens, that's clearly not worth it, because I'm at optimum here. Okay? Now, if I'm endowed with more than majority of the tokens, it's actually beneficial for me, profitable for me, to sell the tokens, because other users will be willing to pay and overpay, because they will know that if they are paying, the price will go lower. We're getting so nobody will want to. There will never be the case that somebody holds all the tokens. Great, right? So we are going to at least not get like everyone holding all the tokens. We're just going to have maybe just this bare majority. Okay. Okay. So the second result that we get is that, or maybe the first part of the second result is that indeed we can get this optimal equilibrium or optimal outcome in equilibrium under certain conditions, okay? But those certain conditions are very narrow and strict. So if we start with the initial distribution where non-users have no tokens, right? So no, everybody who owns the token will want to use the platform after the vote, okay? Supermajority of users have at most one token. So you cannot create a majority of token holders. So you cannot take a majority of tokens created in such a way that there are people who have more than one token, at least 2 tokens. So if you take all the 2 token holders, they're not going to be holding majority of tokens. Okay, there's other users, those who have multiple tokens, have very few tokens. So it cannot be that there is like everybody else, majority of single token holders, and then one token holder holds everything else. Okay, and all agents are forward-looking and rational. Okay, so under those conditions, we're going to end up in this equilibrium. If even one of those conditions is violated, so you have at least one users, one token holders for all token holders need to be forward-looking and rational. One token holder is not forward-looking and rational, is willing to sell their token at 0. We're going to get a domino effect where trading happens. Once trading happens, the only way we're going to stop the trading domino is if someone has the majority of tokens. So trading is only to get the majority. There is no other justification for trading. So we have this. We end up with a concentration where one token holds majority of the tokens, and would say, well, maybe it's not that bad because it's their majority, so how high the price can go. It turns out that with half of the tokens, the majority holder, and this is when it's the user, right? So it's the better option because this will be the only equilibrium. User always wants to pay more than non-user. So it sets the price that is just barely below the monopoly price. So inefficiency is almost the same. Okay. The upside of this DAO mechanism is that even though inefficiency is almost as high as with monopoly, the value capture is only half as bad because this very majority holder is holding half of the value created, and the other half is distributed among token holders. However, it's distributed among both the users and non-users. So it's the users who are actually hurting the most. Okay, there are other equilibria possible because if we have different, we can have different distribution that gives us different prices, and there's no trading. Okay, but this is because there's no trading. Much time? Exactly. Okay, so let me kind of wrap it up. So users, so we kind of show that there is both limit to concentration and limit to decentralization in DAOs. And this comes from a couple of forces. First, the users who have low utility from the platform prefer to set higher price because they prefer to get the dividend rather than lower the price and use the platform at lower price. But even the users who have high utility from the platform, they will be using the price. They will prefer to set higher price if they have more tokens, because now the dividend is more important, right? And the value of tokens increases with holdings. The more I have, the more valuable is the next token, because I can move the price even farther. I'm closer to my more preferred price and increase the dividend. Okay, so this is going to lead to recentralization and inefficiency loss to close to monopoly. So promises of DAOs not quite delivered. There's more equitable distribution, but little improvement on efficiency. So let me kind of still have 30 seconds, 1 minute. So kind of what we actually do see, even among the DAOs that we have right now, and they are not really fully decentralized. They are not decentralizing all the decisions. So the DAOs that we see, that we observe right now, clearly show this tendency of centralization of token holdings. So even if they start very decentralized, they end up with higher centralization. So this is from a recent paper collecting 9 of the DeFi DAOs. Okay, so conclude. Governance tokens may allow for decentralization and increase of welfare creation, but they do not remove tendencies to recentralize and extract surplus. And I think that the next step is to think about the safeguards that maybe we should set up right now for DAOs, so that we don't find ourselves trying to retrospectively set limits to platforms after they grow powerful and we actually don't know who we want to regulate, right? So we can brainstorm what would be a good ways of limitation. So far, one example would be, okay, let's get rid of the dividend. Let's say that all the dividends are always, all the fees are always burned. But then the question is, where is the value of the tokens coming from? And it's still not clear what is the value of the token, governance tokens coming from, and so on. And I think that Joe is going to tell us more about what are different mechanisms and safeguards that we can introduce to those smart contracts that may maybe improve those DAOs. With that, thank you very much.
Thank you. Time for a couple of questions, if they're quick, right over there.
So you talked about this sort of majority voting mechanism. So you see, I like the voting mechanism. Yeah. So what if you allowed people to do this direct voting where everybody votes, you're trying to set some price P, everybody votes for a price, and then you take the weighted average of the prices, right? Then sometimes maybe you don't get this like dichotomous zero, not zero.
Oh, so this is so we can discuss the kind of the voting, how the voting on prices happens, but here everybody is going to have single picked preferences over the price that they prefer. And if you have single picked preferences, you are always going to have a Condorcet winner. So whether they are going to whether we are going to have pairwise voting or any other voting, we are going to always end up with the same price, as the outcome of the voting. And that is here I kind of show the pairwise vote, like only dichotomous voting, because there were only either users or non-users, because all users were holding one token. Yes, it gets more complicated when users are holding different number of tokens and their preferences differ. Yeah.
Quickly.
Just quickly following up on your previous point, does this suggest that we shouldn't be distributing surplus to like these token holders? If we were to leave it just with the users, would that resolve the issue?
Well, so the thing is that you need to know who is the user a priori, right? So you need to know who would be the type, who will be user after the price is set. Okay, so yes, so if we distributed our tokens only to those who, after voting on the price, will end up using the platform, then that would work. But then how would we do it in practice?
You can say you can't use the service without owning some tokens, right?
You cannot use the service
without owning some of the tokens.
Yes, but you can own the tokens without using the service. Like you can own the tokens, the liquidity tokens that you got from the previous periods, and you can vote with them without using the liquidity pool, without providing liquidity this period. So that's you would need to burn them or something.
All right, thank you very much.